So one specific kind of expense is capitalization and depreciation. It's a separate line item on your Schedule F, and it requires separate forms to come up with the numbers that go in that on that line. Depreciation is for anything you've purchased that has a life longer than a year, basically a useful life longer than a year, and which are a lot of things, and some things are small purchases and they last more than a year. So there is an option called Section 179 deduction where you can take that cost and just as an expense. You expense that out, it's referred to. But there are reasons, and sometimes you're required to spread that expense of an item over the years that it's being used. So um, there are specific categories of how many years things are considered to be useful. So it's not just something you're coming up willy-nilly. I think I'll use this a certain amount of time. There are very specific categories, and there is another IRS publication available online or on paper called How to Depreciate Property. And that has actual charts that will show you the different items. In the Farmer's Tax Guide, there's a similar chart that shows very specific farmer typical items, tractors, etc. Different kinds of animals have different years that they expect them to last, and then that using the numbers they give, if it's a 5-year property, a 10-year property, a 25-year property, you use that to go to another chart, which will show you how much you can deduct each year. And sometimes it's a straight line method, it's called, that it'll be the same amount each year, or each year until you've claimed that entire expense. Sometimes it's called makers, which is you are able to expense more in earlier years and then it peters off throughout, as the item gets older. So sometimes you can sometimes choose which system to use based on how it impacts your taxes. To your benefit, of course, you'd want to do it, but a few things are required to be used a certain method, and so that's just something you have to research on whatever the item is. I can't speak to everything. For example, for us, we built a barn. It housed many different kinds of animals. It didn't cost very much because we did it all ourselves, and at the time, we maybe would have liked to deduct the whole amount. But for a couple of reasons, often, well, no, real estate cannot be deducted in one time. That's a property that doesn't depreciate, so you actually can't deduct it. But for a physical barn, if it's a single-use structure, you can deduct it in 1 year. If it's a building that's only gonna, like a greenhouse, it's only gonna grow plants, you can take that deduction, $2,000 in 1 year. If you're gonna grow plants and you're going to raise chickens in that facility, now it's multi-use, and that you have to depreciate according, at least when we built our buildings, the rules were that had to be depreciated. And the years it gave, like for a barn, a much bigger, more solid structure, I think was 25 or 30 years. We actually just finished depreciating our barn, and I think it might have been $4 that we got to take off. So it had been a lot in the beginning, and it went down over 30 years to a very small amount. But I took every dollar that was allowed us over that time. But because we had used it for multiple reasons, it had to be spread out over all those years. The benefit of that, there are reasons to choose to deduct something if you're allowed to in 1 year, the Section 179 deduction, or to capitalize it, spread it out. The different reasons might have to do with how much income you've made in a particular year. You may want, if you have a lot of income at the time that you're building these things or purchasing these things, you may want to take that expense so that you don't owe a lot of taxes in that year. But if you're actually at the beginning of your farming business, you don't have a lot of income maybe. And so you'll actually have a loss, which may be good if, in the sense that if you have other income and you want to reduce your tax liability overall, but you may have hopes of making lots of money in the future in your farm venture. And if you've already expensed everything, you've already taken the deduction for all the expenses you've made, you will have a lot of income to pay taxes on in that future time period. And so there might be a good reason for you to spread that cost out more generally over the time period of that item so that you can take some of that expense when you're actually making money off of what you spent that on to do that. And so those are personal decisions. They're record-keeping decisions in the sense of it's a small amount of money, it might not be worth the record keeping. to keep a $100 item. Usually, usually $100 items don't last that long, but there might, the record keeping might not be worth it. But for larger ticket items, it generally is a decision to be made. You can also deduct part of it initially. You can take a chunk off, um, and deduct it as an expense, and then the remainder of it as a 179 deduction to expense, and then the remainder of that purchase can be spread out over the years of the life of that item. So again, in our case, I can bring up our well again. I think we didn't have a lot of income when we were first starting our farm. It took us 10 years to break even. And so, but we didn't want to take all of our expenses right away, certainly not more than we needed to take to kind of get our tax liability down to zero. And so we claimed a chunk of that amount as a Section 179 deduction. But then we left $2,000 or $3,000 that we spread out over the next 5 or 7 years. I don't remember how long exactly for that item. But and then that helped reduce our tax liability on future income, and so it all makes sense when you think of how you spend money and how you budget money, in the sense of you buy something and you want it to last, and so that cost is kind of being balanced throughout time. And but you do want to do it in a way that has the best effect on your tax liability. And so that's to be informed and test the different ways to do it is worth the effort often. The other thing for different items, for things like buildings or tools, that's pretty easy to figure out. For things like, in our case, planting an orchard, there's something called the capitalization rule, which when you plant a tree, say an apple tree, its production, it has a pre-production period. There's actually a fixed amount of time before you even expect to get any money out of it. And so the rules, the capitalization rules for things like that, are that you gather all those expenses, you keep track of all those expenses, and then when that tree becomes productive, that's when you start deducting them. So again, there's an exception to that. It has to be listed separately as an expense if you choose to take some of those expenses prior to that production period, when that production period starts. But there's an advantage to it in the sense that you get to save the benefit of having those expenses to when you are starting to get income from that item. And so again, those are things that to be aware of and to do your research and to know with whatever it is that you're producing, how the rules apply to your crop or your animal. Breeding stock is treated different than breeding stock is considered a capital expense. So you can, if you're buying a cow to produce more calves, you would treat that as a capital purchase with a lifetime. If you're buying a cow to raise and sell as meat, that's more like putting a seed in the ground and harvesting a crop. So you treat that more as that's what I mentioned, the second type of income that you record is that when your purchase price taken out of your sale price is your income, is your profit that you record in your income line for that. That's when you bought an animal for resale. But if you bought it for breeding, it's capitalized, you depreciate it, or choose to do the Section 179 deduction. But then in our case, for instance, we had a draft horse we bought to raise and work. We took it as an expense in the year we bought her, thinking, great, and then when we sold her, however, we used her for breeding, we used her for work, we sold her many years later to another farmer. We had actually no expense to claim against quite a large sale. That was completely a capital gain on our part. It didn't even count actually as farm income. That was a capital gain, which is listed in a separate part on your tax form. So it's not, we didn't raise even, so that it was a surprise to us. We learned from that to have those things in mind and how it impacts the rest of your income level. So at that time, it actually impacted a lot of other things because we were very low income, and that all of a sudden made us look very rich, even though that wasn't. It was what we thought was a farm kind transaction. It ended up being a capital gains transaction when we sold that breeding animal. So know the impacts of your particular circumstances, and I can't speak to all of them. I only know what we experienced ourselves and learned from in making our ongoing decisions.